Thank you, Lee.
Thank you, Marty. Well, good afternoon, everyone. The question is, what happened in 2007? Retail certainly proved the old saying that the only thing constant is change. The economic turbulence of 2007 accelerated the retail market swing from the boom of recent years to the downturn by year end. Retail was the #1 casualty of change in our Twin Cities real estate market. However, there's no need to panic. We're encountering rough waters. We're not encountering a tsunami. Now, Charles Darwin stated that it's not the strongest of species that survives, and not the most intelligent, but the one most responsive to change. Retail will respond to this challenge in 2008 by adopting strategies better suited to success in this new environment. 2007, retail proved to be a mixed bag. To the good, absorption was positive at 6%, a slight improvement over 2006. Nordstrom made its long-awaited announcement to open a second Minnesota store, and both Walmart and Target opened new stores and upgraded older stores into bigger and classier formats. Specialty retailers remained vibrant. The 50th in France redevelopment attracted upscale retailers such as Sur La Table and COS, both new to our market. Now to the bad. The mid-year subprime crash and its domino effect hit retail the hardest, with yet harder aftershocks projected for 2008. Reduction became the byword for all sectors in 2007 retail. Reduction in demand for retail space resulted from contraction across the retail spectrum, from nationals to franchisees to locals. Now, retail follows rooftops, but when housing starts screeched to a halt, so did the outer metro expansion. Finally, we saw ongoing reduction in the number of planned retail projects. The main factors contributing to this decline were increased cost of money, rising construction costs, heightened bank underwriting standards, and high land costs. Ramsey Town Center serves as the most glaring example of retail boom gone bust. So what opportunities await us in this changed retail environment? In order to unlock these opportunities, we need to understand the paradigm shift that occurred in 2007. Making money has always been the goal of retail, but the how has shifted from where aren't we and how fast can we get there to where can we maximize capital yield with finite cash resources. So how will retail in general respond to a capital-driven market? The retailer will respond in part through increased caution and careful relocation. A major example is Walmart's reduction of planned 2008 stores from 280 to just 140, a pattern likely to spill into 2009. Retailers will relocate or close stores that fall short of their profit targets and add stores only where careful financial modeling predicts a high capital yield. Macy's and Talbot's are just two of the nationals in store closing mode. Franchisees and local retailers. They face diminished availability of funds due to maxed out home equity, declining home values, and concern over the economy. These factors put potential franchisee and local retailers into a wait-and-see or exit the market mode, and limited expansion will be the result. By employing defensive leasing strategies, owners will be able to improve cash flow reduced by rising vacancies. Landlords will offer lessee inducements to stem the bleeding, such as free or reduced rent and extra TI money. A smaller profit is better than a loss. Finally, developers will approach any new project with increased caution. Lease rates have topped out, so there is less profit and more risk of vacancy than in prior years. Developers need to think outside of the big box to wring their best yield on capital. Creative retail development opportunities await developers who broaden their vision beyond purely retail to a mixed use that justifies higher land prices. We will see more horizontal mixed-use projects in 2008, combining retail with apartments or hotels or other higher density uses. Vertical mixed use will prove a new opportunity arising from the construction of light rail corridors. The North Star Rail, slated to open in 2009, will have 5 stations. It's the 3-block radius surrounding those light rail stations that will be the location to pursue, particularly for service and quick-serve concepts. Lucrative site development opportunities are also created by new traffic arteries. The new Highway 312 in Eden Prairie will offer hard corners, excellent access and visibility, and high vehicle per day count with strong demographics. Creative opportunities will be found in distressed land as well. More infill and redevelopment will occur in 2008 as developers are challenged to find dense metro sites for retailers. Now, retailers will grasp opportunity in this changed climate by becoming more consumer-centric. They will customize their inventories to fit store-specific demographics. Walmart has been on this forefront of the trend. Increasing creativity in rebranding and marketing, like Starbucks, who has suffered a dip in sales, and increasing customer service. All of these things can increase sales. In the construction arena, retailers will hop on the green wagon. LEED certification and government credits for going green will create development opportunity through cost reduction. Walmart is reducing energy costs by 25% over original supercenters through its high-efficiency stores. Right-sizing will also be an effective tool to improve capital yield, adjusting building footprints to maximize profit for good sites. Downtown opportunities will increase as the Downtown Council implements their strategies for strengthening retail as suggested in their recently released study. More developers will be looking at existing buildings, particularly in the North Loop area, with a creative eye for what that property could be. So Darwin was right on point. Change will be the key to success in 2008. We're confident that retail will rise to the challenge. Thank you.